is higher than it has ever been in recorded history. And that probably includes the 1929, September 1929. I mean, this is very, very serious stuff. So if you get rising bond yields, you see the 10-year moving up towards 4.75%, looking like it's going to go to 5%. Then there's going to be a stock market crash. Geopolitical thing, which is fascinating, is China. I know that China has accumulated an awful lot of gold, which is off balance sheet, as it were. So 2026 is going to be, I think, a very difficult year for those trying to protect their wealth. I mean, it's very, very difficult. I know the answer, but I can't get anyone really, well, I mean, apart from a few gold bugs, I can't really get anyone to go with me. We've got, I don't know, it's a sort of gathering disaster, I think. When I look at the situation in America, I mean, you had retail figures which came out today being Tuesday, the 10th, I think. And of course, what happens is gut reaction in the market, mark down bond yields, in other words, mark up bond prices, because guess what? The betting now is there will probably be 3 Fed cuts in 2026. This is a load of rubbish, it really is, because what gold has signaled and is still signaling is that the purchasing power of the dollar is going down. It's not gold being in a bull market, it's actually the dollar being in a bear market in terms of its purchasing power. That's the key thing to understand. Now, with that in prospect, if the Fed is going to cut rates, it's going to be in defiance of soaring consumer price inflation as the dollar buys less, if you like, during the course of 2026. So the market, I think, has got this entirely wrong. There's a lot of sort of hopium in the whole thing. Of course, there's also a bubble in tech stocks and so on. And, you know, you just need to look at the amount of margin debt reported by FINRA. On top of that, I mean, that's running now at 1.2 trillion. That's up from around about 250 billion at the time of the great financial crisis. As well as that, of course, you know, the big players like hedge funds and so on, when they leverage up their positions, they don't go to FINRA, they go to the banks. So, you know, the FINRA numbers are just the tip of a credit iceberg, which has inflated stock values. Now, the point about rising bond yields, when it happens, the bond yields will rise for the simple reason that when inflation starts rising, initially it's commodities, then it's producer prices, and then it's consumer prices. And that starts feeding through. Bond yields are going to start rising out along the yield curve. And already, equities are very expensive relative to bonds on any measure. In fact, what I do is I put together a chart which compares the two, and you can see that from a normal trend where the two, if you like, are in complete antithesis in terms of, bond yields down, equities up. They follow a track which is absolutely fine, but it's now got so distorted. The distortion in terms of overvaluation of the S&P index relative to the 10-year or the 30-year bond is higher than it has ever been in recorded history. And that probably includes the 1929, September 1929. I mean, this is very, very serious stuff. So if you get rising bond yields, you see the 10-year moving up towards 4.75%, looking like it's going to go to 5%, then there's going to be a stock market crash.
Equities remain historically expensive relative to government bonds, and leverage across the financial system has surged. Margin debt has multiplied several times over since the 2008 crisis, and that figure excludes leverage embedded within hedge funds and institutional financing channels. This expansion of credit has inflated asset prices far beyond underlying economic productivity. If bond yields resume climbing, particularly on longer-term treasuries, the pressure on overvalued stocks could become severe. A move toward 5% on the 10-year yield may be enough to trigger a broader repricing. When debt sustains valuation, rising borrowing costs become the breaking point.
Geopolitical thing, which is fascinating is China. I know that China has accumulated an awful lot of gold, which is off balance sheet, as it were. And I've been rereading the original regulations of 1983, appointing the People's Bank of China as the government's sole agent for managing the state's gold and silver reserves, acquisition and dealing. And there's no doubt about it that there is a lot of gold in China, in the state, which is spread around various accounts. Article 4 describes how that can happen. And if you go on from there, there's a different mechanism for them to accumulate huge amounts of silver. We don't know how much silver, we don't know how much gold. My guess is that the state by 2022 accumulated something in the region of 20,000 tons. They will have accumulated a similar additional sum since then, in my view. Now, I've got no firm evidence of this whatsoever, but this is just working it out, circumstantial evidence, if you like. When it comes to silver, well, all you need know is that, rather like gold, I mean, China rapidly invested in gold mines, so the result was that for the last 15, 20 years, she's been the largest gold miner by output in the world. But this is a small part of what she's been doing. She's also been importing doré from elsewhere, refining it and hanging on to it. And we know how she's absolutely drained Western vaults of their gold. The same is true of silver. The way she worked silver was somewhat differently. She's now the second largest silver miner in the world. She's been importing silver doré and refining that. I mean, even Mexicans' silver doré has been going over there. And on top of that, she's been refining non-ferrous ores, which contain silver. And something like 60% of the world's silver, remember, comes from, as a byproduct of refining non-ferrous ores. So she's been doing that too. She's accumulated a huge, huge quantity of silver, the amounts of which we just don't know. But this has been a policy that she's been doing while suppressing the price until literally, I suppose, around about September last year. At that stage, you had the sort of the spat with America over rare earths. And silver, as a critical mineral, was also part of that policy. Not directly, but indirectly. I mean, what followed the rare earths, clampdown on rare earths exports.
If markets falter sharply, authorities face a critical decision: allow liquidation or intervene aggressively. Modern policymakers have consistently chosen intervention. Unlike the early 20th century, governments no longer permit full market cleansing through collapse. Instead, they deploy liquidity programs, asset purchases, and monetary expansion to stabilize financial institutions. However, this rescue strategy comes at a cost: the currency itself. When faced with systemic risk, policymakers often prioritize preserving banks and markets over defending purchasing power. Historically, governments confronted with excessive debt resolved the imbalance either through default or through currency debasement. In today's environment, devaluation appears the more likely path.
Opening a vault in Hong Kong, opening a vault in Saudi Arabia, making gold exchangeable for yuan, and she will fix a rate at some stage. I wouldn't mind betting that that rate will be fixed for international trade settlement purposes. So it'll be like a sort of Chinese version of Bretton Woods Mark II, if you like. What she does with the domestic economy, I don't know, but I'm sort of theorizing hugely here. The last metallic standard which China had was actually a silver standard up until 1935. Now, this means that the domestic users of yuan are familiar with silver as backing for the currency. Now, she's got enough gold and enough silver to ensure that a ratio between the two will stick. So that way she could actually secure the domestic yuan against silver. Now, the reason I think this is likely is that I just detect with central banks as a whole, and I'm sure this is the case with the People's Bank of China, a huge reluctance to part with any gold to the great unwashed public. So The idea of, let's say, the post-Napoleonic Napoleonic War gold standard in the UK, where you could exchange £1 for one sovereign at the user's option, at your option. I think we're a long way from that, and I think that the first cut on this is going to be, we want to try and do this at an institutional level because we can control things a lot more, rather than do it on a public level. So I think the public will probably have their domestic yuan secured by silver. Now, as I say, I'm theorizing here completely. I've got absolutely no evidence that this is going to be the case. But given that there is no evidence that this is likely to be the case, you have to ask yourself why it is that they've had this policy of accumulating huge amounts of silver. And this was before, sort of photovoltaic panels, and before electric vehicles and all the rest of it, before the main industrial uses today, if you like, before they really took off. I think that it would make some sense for them to go down that route. My preference, if I was advising the Chinese, would be to put in a proper gold standard. But I think the point, Christian, is that we are obviously not too far away from the destruction of the dollar. It's a lot closer than we actually might have thought, let's say even months ago. And China is moving to protect herself. How she quite does it, we'll see. But she's given enough indications through her actions so far for us to be able to guess pretty much how she will protect her currency. And she's also signaling through her actions that she's having to get a move on because she thinks that the dollar is going to collapse quite quickly. It may be because she watches the price of gold. I don't know. But you can see that, things are hotting up. They really are. So 2026 is going to be, I think, a very difficult year for those trying to protect their wealth. I mean, it's very, very difficult. I know the answer, but I can't get anyone really, apart from a few gold bugs, I can't really get anyone to go with me.
While Western economies wrestle with debt saturation, China has quietly accumulated substantial gold reserves and expanded domestic refining capacity for both gold and silver. It is now one of the largest producers and importers of precious metals globally. Simultaneously, Chinese institutions have gradually reduced exposure to U.S. treasuries and tightened controls on cryptocurrency activity. These actions suggest preparation for monetary realignment rather than short-term positioning. By strengthening commodity reserves and reducing reliance on dollar-denominated assets, China may be positioning the yuan for a larger role in international trade settlement. Monetary strategy increasingly overlaps with geopolitics.
Basically, the high level is that equities are doomed. Bonds will be doomed as well, because you're going to collapse the purchasing power of the dollar, then, yields on the 30-year long bond. I mean, that's not going to stop at 10%, not going to stop at 20%. It's blue sky above there in terms of yield, which is catastrophic for any bond investor. I think the interesting thing perhaps is the mining sector, because, obviously mines, I don't think have really caught up, particularly in the case of silver mines, with the new environment for silver. I think that's also true for gold. So that is really where the value is. Now, having said that, I would have thought that if we do get a market crash, the bubble bursting, then I think that they could be a source of funds for the distressed owners, if you like, of tech funds and all the rest of it, where they've got them. So they might be temporarily weak, but I take that as an opportunity to pick up mining stocks. There is another aspect to this, and that is you've got to sort of look back and think, well, we know that gold has secured the value of credit before and all the rest of it. But what actually does gold represent? Well, the answer to that is stability in prices over long periods of time. And that stability is really best illustrated by, if you like, baskets of classes of commodities. So, for example, base metals. You would expect base metals. Some of them are going to go up and go down because you're going to get changes in demand and supply characteristics individually and all the rest of it. But if you take a basket over a period of time, you would expect the value of that basket measured in gold to be relatively constant. Well, I can tell you that, the IMF do run a basket which they value in dollars, but if you, or the index. But if you take that back to where gold was in the year 1900, when the Gold Act came in, securing the de facto gold exchange rate of 20.7 de jure, as it were, so that it became law, then compared with that, we are, if you look at this basket of metals, they're roughly at 20% of where they should be. In other words, they have fallen about 80% measured in gold. Now, some of that, you would argue, is because the gold price has risen. But why has the gold price risen? The gold price has risen because the purchasing power of dollars is going down, and it's going down a lot more than the CPI or whatever other, spurious measure you might try to use. What that means is that with a collapsing dollar, not only are you going to see that basket of commodities rising against gold, but it's going to be rising even more against a dollar with a falling purchasing power. So this means that we are on the verge of a huge, huge rise, if you like, in dollar terms.
A significant structural issue lies within commodity derivatives markets. Financial contracts tied to metals, energy, and agricultural goods often exceed the available physical supply many times over. During normal conditions, this leverage remains hidden. But if investors demand physical delivery rather than paper settlement, stress can emerge quickly. Silver illustrates this imbalance particularly well, as industrial demand intersects with monetary interest. When derivatives vastly outnumber underlying supply, either contracts fail or prices adjust sharply upward to rebalance demand. Historically, gold has preserved purchasing power over long periods, while fiat currencies have steadily eroded. Commodity repricing may reflect that correction.
The only thing that can happen really is one of two things. Either the derivative concerned collapses because it's valueless, because it can't be transferred into the real stuff, or the price of the real stuff has to rise to the level where conversion demand from derivatives into the real stuff is actually satisfied. And what level is that? If you look at silver, is it 100, 200, 300, 400, 500? Who knows? We don't know. This is going to be really interesting. I think as far as investors are concerned, they really should be thinking hard about commodities as a whole. And if they're not buying ETFs or whatever, and I'm not a great fan of ETFs, quite frankly, because I think they misrepresent a position. But, you've got commodity producers, miners, whatever, which are interesting. That's something which I think you should do some research into and get the hell out of some of this stuff, which has really depended on the credit bubble to push their values higher. They're going to collapse. And I think initially, as I said, I think it could be a problem for the stuff you should be in. To go back to the great financial crisis, what we saw gold being driven down from $1,000 just before the crisis to, I think it hit a low of something like $680 before subsequently going on to, $1,200 or something in 2011. No, $1,900 in 2011. There could be that initial sell-off, if you like. But my goodness, what an opportunity then to shift into something that's going to represent commodities and is a perfect hedge to get out of fiat currency risk. You still have credit risk because it's not the same as gold. Gold is final settlement. So silver, if it is accepted, final settlement in the sense that there's no counterparty risk. If you own mines, you've got counterparty risk. You've got a management that's meant to deliver you an income and earning stream as a shareholder. But you don't even have that half the time, because how do you hold your shares? They're in certificateless form. What that means is that there is another party in between you and the company, the mining company. So the responsibility for the mining company is not to you. It's actually to, say, the DTC, or in our case, Euroclear. And they can use your shares as collateral in a meltdown in order to save the system, themselves, in other words.
In periods of systemic strain, the structure of ownership becomes critical. Many financial assets today are held indirectly through custodial chains, clearinghouses, and intermediaries. Legally, investors often possess a claim rather than direct title. During stability, this distinction feels irrelevant. During crisis, it may not be. Beyond markets, geopolitical tensions from Eastern Europe to the Middle East add further uncertainty, particularly regarding energy supply routes and global trade. Oil disruptions alone could amplify inflation dramatically. As monetary, financial, and geopolitical risks converge, independent analysis becomes essential. In uncertain times, preserving purchasing power and understanding counterparty exposure may define financial survival.